Gambling and real money gaming is one building block inside the wider travel, hospitality, and leisure sector. But unlike a hotel room, a theme park ticket, or a gym membership, here the customer is paying for a chance. It might be a sports bet, an online slot, a spin of the roulette wheel, or a lottery ticket. The whole experience is wrapped around risk and reward. You can think of it as a different way of spending leisure money. Instead of buying a fixed experience, the customer is accepting uncertainty. Sometimes they lose their entire stake. Occasionally they win big. That trade-off between risk and reward is what defines this block and sets its economics, its regulation, and its social perception apart from the rest of the sector. Inside this block, we can group businesses into three broad types. First, we have online operators, the apps and websites where people place sports bets, play casino games, or join poker rooms entirely in digital form. These are the names most of us see advertised during sports broadcasts or on our phones. Second, we have land-based gaming operators. These are the traditional casinos and betting shops, sometimes sitting inside wider resorts, but with economics driven mainly by the gaming floor rather than the hotel room or the restaurant. Third, there are B2B suppliers. These companies sit behind the scenes and provide the technology and content that makes the whole system work. The platform software, the game content, the odds feeds, the risk management tools, and the payments infrastructure. They may not be visible to the consumer, but they are essential to keeping bets flowing and systems compliant. Within the TLH framework, gambling and real money gaming acts like a risk and reward overlay on other leisure activities. A casino gaming floor, for example, helps pull traffic into the hotels and resorts that sit in our physical destinations and venues block. The casino may be the main draw, but the hotel, restaurants, and shows capture additional spend. Sports betting, especially online, deepens engagement with the Gen Z digital lifestyle and fandom block. Fans who place a small bet on a match are more likely to watch the full game, follow statistics, and engage with sports content on social media. Online gaming platforms also rely on many of the same digital mechanics as travel platforms and membership models, mobile apps, loyalty schemes, and personalized offers. In the value chain, this block usually sits closest to the customer's cash. It takes in deposits, pays out prizes, and whatever is left over funds the ecosystem, operators, suppliers, governments, and, in time, investors. That proximity to money is attractive from an investment point of view, but it also brings more scrutiny from regulators in society. If we look at the business models, most of the capital light value lies with online B2C operators. These businesses invest mainly in software, brand, licenses, and marketing rather than in concrete and steel. Their economic engine is simple in theory. Over time, the hold, the percentage of betting volume they keep after paying out winners, must cover operating costs and leave a profit. The key variables are what it costs to acquire a customer, how much gross profit that customer generates over their lifetime, and how well risk is managed so that short-term sports results do not overwhelm long-term probabilities. Land-based casinos and retail betting outlets are far more asset-heavy. They have to fund land, buildings, interiors, gaming equipment, and, often, hotels and entertainment. Once these properties are built, the gaming floor can be very high margin. A relatively small number of tables and machines can support a large fixed cost base. But returns are very sensitive to utilization. When the floor is busy, incremental wagers drop almost straight to profit. When it is quiet, the same fixed costs continue, and cash flow quickly deteriorates. B2B suppliers. The platform providers, game studios, data and risk specialists, and payment processors typically run asset-light recurring revenue models. They spend capital on software development, intellectual property, and regulatory approvals. Their revenue is often tied to a share of operator turnover or win, or to long-term software contracts. They avoid heavy marketing spend and some regulatory risk, but they are exposed to a smaller number of large customers. Across these business models, a handful of drivers dominate. Regulation and licensing decide whether a market is legal, how many licenses are granted, and on what terms. Tax and take rates determine how much of gross gaming revenue is claimed by governments through taxes and fees. Customer acquisition costs show how expensive it is to bring in a new player via bonuses, advertising, and affiliates. Product mix and hold also matter. The balance between sports betting, casino, poker, and other games shapes how volatile or predictable the revenue line is. Finally, technology and user experience. The speed and reliability of the platform, the quality of the app design, and the breadth of available markets drive engagement and loyalty. Bargaining power in this ecosystem is skewed. Regulators and governments sit above the industry and can create or destroy value by changing rules and tax rates. Within the commercial chain, large-scale operators with strong brands, proprietary technology, and rich first-party data usually have the upper hand over small white-label operators or single-studio suppliers. Sports leagues and owners of key intellectual property can also gain leverage as integrity fees and data rights become more important. The risks at industry level follow naturally from this setup. A tightening of regulation or a sharp rise in taxes can compress margins almost overnight. Scandals around match fixing, problem gambling, or VIP programs can trigger political backlash and lead to restrictions on marketing or product design. Over-competition can drive irrational promotional spending so that industry profits lag behind headline revenue growth. And for asset-heavy casinos, overbuilding into a slowing cycle can leave balance sheets over-levered for years. The long-term numbers help explain why this block attracts so much investor interest. Industry data from H2 Gambling Capital show that the global online gambling market has grown from roughly $37 to $38 billion in 2015 to around $90 billion by 2025, with a high single-digit compound growth rate. You can see this clearly in Figure 2, Global Online Gambling Market Size, where each bar climbs steadily over time. At the same time, total global gambling revenue, including both land-based and online, has also risen. Figure 3. Global gambling revenue shows that land-based venues still account for the majority of revenue today, but the online segment, shown in a different color, becomes a thicker and thicker slice of the bar each year. By the end of the decade, online is expected to represent a much larger share of the total pie. Within online gambling, different products grow at different speeds. Figure 4. Online gambling market growth by sector breaks the market into online casino, online sports betting, and poker, and other activities. The chart shows that casino and sports betting have done most of the heavy lifting, with both lines rising sharply between 2015 and 2025, while poker and other games grow more slowly from a smaller base. So when we talk about the economics of online gambling, we are mainly talking about casino-style games and sports betting. Behaviorally, this block does not move in exactly the same way as classic holiday spending. For many customers, gambling is a habitual activity tied to sports calendars or daily routines, rather than a once-a-year splurge like an overseas trip. That gives parts of the industry some resilience when discretionary budgets tighten, but it also raises social and regulatory sensitivity. When disposable incomes fall and unemployment rises, casual bettors often reduce their stakes or bet less frequently. Core users may continue to play, but they may shift from occasional visits to land-based venues to smaller, more frequent online bets. When interest rates rise and credit becomes more expensive, asset-heavy casinos feel it in two places: higher financing costs on their large property portfolios and more cautious, high-value customers. Online operators, with fewer hard assets, mainly feel the impact through lower marketing effectiveness and softer new customer growth. Regulation is the main macro variable that really matters. When governments decide to legalize and tax online betting, a large informal market can move onshore, lifting reported revenues and improving visibility. When they raise gambling taxes sharply or ban certain types of advertising, margins and growth can fall quickly, and a black market can reemerge. Technology platforms also play a role. If app stores, payment networks, or social media platforms change their policies, the economics of customer acquisition can shift almost overnight. Compared with the wider TLH sector, gambling and real money gaming is often less cyclical on revenue, but more volatile on regulation. It can be more resilient than big-ticket travel or leisure when consumers feel poorer, but it is far more exposed to political risk than, say, gyms or sporting goods. Online components can even see increased engagement when people spend more time at home, while physical casinos still rely on travel, conferences, and tourist flows. The last 5 years have brought genuine structural change. The most obvious shift is the migration from land-based to online and mobile formats, combined with more gamified products. In-play betting, same-game combinations, micro-bets on small moments within a match, and highly gamified casino interfaces all appeal to a younger, mobile-first audience. These features increase engagement and turnover, but they also make it harder for regulators to distinguish entertainment from harmful intensity. Gen Z and younger millennials now drive much of the growth in regulated online markets, especially in sports betting and iGaming. At the same time, youth exposure to gambling advertising has become a major concern for regulators and charities. Figure 1. Youth experience of gambling from the UK Gambling Commission shows that around half of 11 to 17-year-olds report having experienced gambling in some form, and roughly a quarter are actively involved, with similar levels for boys and girls across ages. That is a striking backdrop for any policy debate. These trends change where power sits. Digital native customers are less loyal to physical venues and more sensitive to app quality, odds, promotions, and social proof. That favors scalable online operators and strong technology or content providers. But it also invites tighter rules. Staking limits, mandatory checks, bans on certain VIP schemes, and stricter advertising rules are all on the table in multiple jurisdictions. Business models built around aggressive promotions and a small number of high-value VIPs become more fragile, while those built on broad, smaller-stake customer bases and strong compliance may prove more durable. Looking ahead, it helps to think in time frames. Over the next 1 to 2 years, much of the story is still about normalization and regulation. Newly opened online sports betting markets are likely to keep growing fast in terms of betting volume and revenue, supported by ongoing legalization and product innovation, as industry trackers such as Legal Sports Report suggest. At the same time, regulators are catching up, reviewing advertising, VIP programs, affordability tests, and tax rates. So we should expect continued headline growth for online segments, but with pressure on marketing intensity and some compression in margins as rules tighten. For land-based casinos, the near term is more about stabilizing visitation and rebalancing the mix between gaming, hospitality, and entertainment. Over a 3 to 5 year horizon, the block as a whole is likely to move from land grab to consolidation. Subscale operators that overspent on marketing may be acquired or exit the market. A smaller set of scaled brands and platforms is likely to dominate each regulated jurisdiction. B2B providers that can offer turnkey solutions, platform, content, risk tools, and compliance should continue to gain share as regulation becomes more complex. On a 7 to 10 year view, this block may start to look like a mature, regulated utility in some markets and is still normalizing growth story in others. Online penetration should be structurally higher. Land-based only models are likely to shrink as a share of total revenue, but remain important as experience-led destinations. Integration with media and entertainment, live odds and sports streams, interactive formats, and more immersive experiences is likely to continue, but within tighter guardrails. The main uncertainties over that horizon are social attitudes and political tolerance. Sustained public concern about youth gambling or problem play could lead to much harsher constraints. Well-run markets with strong consumer protections, by contrast, may stabilize into long-lived cash-generative oligopolies. For a long-term investor, the core message is simple. Gambling and real money gaming can produce very durable cash flows, where 3 conditions hold. The regulatory regime is stable and credible. Taxes are high but predictable. And operators or suppliers have genuine scale, technology, and compliance advantages. The main risks are not short-term sports results, but changes in law, public mood, and technology that shift value between operators, suppliers, black markets, and the state. Watching how Gen Z behavior evolves, how regulators respond, and where online versus land-based economics settle will be key to judging which business models prove enduring and which were just part of the opening act.